Here's the shocking truth about investing. Most beginners lose money not because the market is risky, but because they make the same 3 mistakes over and over. Watch this before you invest a single dollar. If you've been thinking about investing but feel overwhelmed, you're not alone. The jargon, fear of losses, and endless contradictory advice can be paralyzing. But here's the secret. Successful investing isn't about luck or timing. It's about following a few proven principles that anyone can master. Stay with me, because tip number 4 could save you from years of financial regret. First, only invest in what you understand. If you can't explain how a company makes money in simple terms, don't buy its stock. This is why beginners should start with broad market index funds or ETFs that track the S&P 500. These funds spread your investment across hundreds of companies automatically, reducing your risk through instant diversification. Second, automation is your secret weapon. Set up automatic transfers from your checking account to your investment account, even if it's just $50 monthly. This removes emotion from the equation and builds consistent habits. Here's the power of consistency. $50 monthly invested in the S&P 500 over 30 years, earning the historical average return of about 10% annually, could grow to over $100,000. Third, never chase hot tips or trending stocks. By the time everyone's talking about a stock or cryptocurrency, you're already late to the party. Instead, focus on long-term, steady growth. Remember this truth: boring investments often generate the most wealth. The S&P 500's average annual return over the past century is approximately 10%, but that requires patience and discipline. Fourth, and this separates smart investors from broke gamblers, build an emergency fund before you invest a penny. Financial experts recommend 3 to 6 months of essential expenses in a high-yield savings account. Why? Because if life hits you with medical bills, job loss, or major repairs, you won't be forced to sell your investments at the worst possible time, locking in losses. Fifth, time in the market beats timing the market every single time. No one can consistently predict market highs and lows. But here's what history proves. Despite crashes, recessions, and panics, the market has always recovered and reached new highs. The longer you stay invested, the higher your probability of building real wealth. Here's your action plan. Understand your investments, automate everything, ignore the hype, build that emergency cushion, and commit to the long game. These 5 principles have created more millionaires than any get-rich-quick scheme ever could. What's the one investing rule you wish you'd learned earlier? Drop it in the comments. I read every single one. If this helped clarify investing for you, hit subscribe for more no-nonsense financial advice. And check out my next video on the biggest money mistakes people make in their 20s. Trust me, you don't want to learn these lessons the hard way.